What's going on, everybody? This is Dr. Kenyon Hackworth from Healthy You, Wealthy You, where my focus is on improving health and building generational wealth. Now, if you're new to the channel, make sure you subscribe and hit that like button. Smash the like button, hit that thumbs up button. I would greatly appreciate it. Now, Warren Buffett talked about 3 investment principles that his mentor Benjamin Graham had for successful investing. Number 1 is that you have to have a proper attitude towards the market. He said the stock market is here to serve you and not to instruct you. You cannot make investment decisions based upon short-term fluctuations in the stock market. Number 2 is that you have to have a margin of safety. That means that you do not want to overpay for a stock. No matter how successful or no matter what you think about a stock, there's no infinite price that you should pay for it. And number 3 is to view stocks as businesses. When you buy a stock, you are buying a piece of a business. When you buy the piece of that business, or when you buy that stock, you then become a shareholder. It means you are part owner of the company. What's important for me is to find high quality businesses that I can buy, that I can own, that my family can own for decades. Okay? So now some of the components of a successful business is, number 1, does that business have a moat or some type of competitive, durable advantage that separates it, that makes it it's hard for other companies to infringe upon its territory. Number 2, is that business profitable? Because you don't want to invest in enterprises or stocks or businesses that are not profitable. And number 3, how is the management team? Does it have a good management team that is very capable of running a business that can create a high return on capital and that can go a long way for generating wealth for you and for your family? Now, there are some important metrics that I look at, and I'll show you a spot where you can go and find these. And when you're looking at a business, okay, the profitability ratios. Profitability ratios is a class of financial metrics that help investors assess a business's ability to generate earnings compared with its expenses. So there are 4 ratios that we're going to look at. Just a brief overview, nothing in grand detail. Profit margin, operating margin, return on assets, and return on equity. Profit margin is a ratio of profitability calculated as net income divided by revenues. It is displayed as a percentage, and these can be found on the income statement in the company's. It can be found on the company's income statement. So a profit margin of 20% means that the company has a net income of 20 cents for each dollar of sales. So if it has a sale of $10 and $2 is kept as profit, then as net income, there's a 20% profit margin. Operating margin. Operating margin is calculated by dividing operating income by net sales or revenue. It is a proportion of a company's revenue that is left over after variable costs of production such as wages and raw materials have been paid. The higher the margin, the better. Just like profit margin, the higher the margin, the better. So operating margin of 15% means the company makes 15 cents before interest and taxes for every dollar of sales. Return on assets. That is an indicator of how profitable a company is relative to its total assets. It's calculated by dividing net income by total assets. And it provides an idea of how efficient management is at using its assets to generate earnings. So that's very important. You want to buy stocks or businesses where the management is very capable of using its own assets to generate earnings. And return on equity is a measure of how much profit a company generates with the money shareholders have invested. And it's calculated by dividing the net income by shareholders' equity. So you want to own companies where when you invest your money, management does a great job of taking that money and generating profit with the money you have invested. Okay, so we talked about those financial metrics that you can go in and look at. So a place where you can find those, if you go to Yahoo Finance or finance.yahoo.com, and you can type in a ticker symbol or a name of the company, like I did here for Apple. So you can come over and click on this bar that says statistics. And when you click on that, you can scroll up and these numbers are right here in this area. Now, just because these numbers are positive does not mean I will invest in that company, because there are other things that I need to look at to determine whether or not a company is a company I want to invest in and I want to own for a long period of time. So Apple, you see they have high profit margins, high return on assets, return on equity, all numbers that are very, very good. Also, when you look at operating cash flow, TTM is trailing 12 months. So the cash from operating the business for the trailing 12 months for Apple was $104 billion. Free cash flow is $73 billion. Like I said, there is, just because a number is positive here does not mean that I will invest in a company. I do own Apple. I will continue to own Apple. My daughters own Apple in their custodial accounts. My sister owns Apple. It's one of those companies that I have zero plans on selling and I will own for a long, long period of time. Now, companies that, like for last year, you can have stocks that get hot and stocks that run up, and then after a while, they began that precipitous fall. So GameStop is one of them. Now, like I said, if I pull up and these numbers that we just talked about are positive, that does not mean I will invest in that particular company. However, if I pull up a company and all these numbers are negative, there's a 99.99% chance that I will not be investing in that company. See, I'm not buying a stock based upon what I think a stock is going to do this month or next month or this year or next year. I am looking for businesses that I can buy, that I can own for long periods of time. And the great businesses you can own for long periods of time, and they will compound your money for a long period of time, especially when you own a group of great businesses that are all working together to create wealth for you and for your family. So GameStop here, you see the negative numbers here. So anytime for me, if I log on and I look at a company and I see negative numbers here, that's not a company that I'm going to be investing in personally. Now, I have no idea what the stock is going to do. Like last year, when I think December of 2020, AMC stock was $2 a share. It ran all the way up to 70. There is no reason or no rationale that stock should have went up, because it was never worth anywhere near that amount of money. So even when the stock was running up, I stayed back and I watched with amazement, but it was not a company that I was interested in investing in. And I am a long-term investor. I look for businesses that I can buy, that I can own for long periods of time. And if you look for the best businesses, the high quality businesses, you can own these companies for a long, long period of time. So here you see the numbers here negative. They're even worse, because they are, it's not a profitable company. And I don't want to invest in companies that are not profitable. Even here, you see this line here, net income applicable to common shareholders. This is like the bottom line profit, if you will, for shareholders. So AMC's bottom line profit for the shareholders over the trailing 12 months is negative $2 billion. So if somebody came to you and said, I'm going to sell you a business, and you said, well, it lost $2 billion last year, but I can tell you it's going to be a great business 2 more years from now, you're not going to buy a business that's losing that much money. So when you're buying a stock, remember, you're buying a piece of a business. And unless you view things differently, that's the way we're looking at things. So Blink charging station, another one. Everybody gets into the electric vehicle craze, and Blink charging stations, I guess they set up charging stations along the highways where people with electric cars will be able to, electric cars will be able to charge their cars up. So another company that I heard about last year, but I had zero interest in investing in it. Zero interest in investing in this business. Now, like I said, I have no idea what the business is going to be 5 years from now. It could turn out very well to be a fantastic and a wonderful business 5 years from now. But as of today, as for me and my house, we will not be investing in this particular company. All right, so another one, Peloton. Peloton, of course, makes the bikes that became so popular during the pandemic when everything was shut down. Same thing, negative profit numbers, negative return on assets, negative return on equity, uh, negative trailing 12 months net income, negative operating cash flow, negative free cash flow. So all these things here are red flags for me. They're huge red flags. And if you're really investing, you want to find the best businesses. You can own these businesses. You don't have to trade in and out of stocks. If you find a group of great businesses, you can own these businesses for a long period of time. So NIO is the Chinese Tesla, as somebody, as I've heard people say, is the Chinese Tesla. Now, again, it could very well become a profitable company, but it's not there yet. Some people take chances and they speculate and say, well, it's going to be great 5 years from now. A great business can be great for 30 or 40 or 50 or a multitude of years. So you don't have to run and try to invest in a company right when it IPOs or the initial public offering. You can wait till the company becomes a little bit profitable. So here it has the negative profitability. All right, same with last one I'll look at is Beyond Meat. The same way. Now, Beyond Meat is making moves. True enough, it's making moves. But at the same time, I can't invest in it. Not yet. It's not a company that interests me. So I'm always looking for companies that have a durable competitive advantage, that are profitable, and management works very, very well with taking my money or taking my cash and returning it or generating earnings that can be beneficial to the company growing and also my money growing within the company. So look for great businesses to buy, to own, and don't look for hot stocks. Avoid the hot stocks. Go in, look at this information here. If you see all these negative numbers, it might be a red flag. It is for me, but you can choose how you want to invest. I know for me and my family, I look for great businesses that I can buy, that I can own for a long period of time. So happy investing. I will talk to you soon. Have a great day.